Hey, good morning, guys. This is Aaron with Equifirst Lending, and I wanted to make a video to go over an amortization schedule. What is amortization? This is a big word and a word that maybe a lot of people are not familiar with, but it relates to your mortgage, and it shows how a mortgage is paid off over time. All right. So I wanted to give a quick example. I love using this bankrate.com mortgage calculator. They have a lot of great useful mortgage calculators. But I wanted to go over a quick example of what an amortization schedule is. As you can see, amortization is paying off a debt over time in equal installments. So for this example, we're going to show how the portion of your payment goes towards your loan principal, which is what reduces the balance of your loan, and a portion goes toward your interest. Typically, with a mortgage loan, the mortgage interest is front loaded. That means whatever your principal and interest payment amount is, a majority of that amount will go towards interest first, and over time, it'll adjust and it'll start applying more actually toward the principal balance, which will accelerate the payoff as you get later in your mortgage terms. So I'll show you guys an example here. For this example, I used a loan amount of $200,000. This person is getting a 30-year fixed rate loan, which is 360 months, and their interest rate is 4.5%. All right. So based on this calculation, our monthly principal and interest payments are $1,013.37. All right. I like looking at this right here because it gives us an idea of the overall amount that the borrower will be paying over the life of the loan. So at the end of 30 years, the person would have paid $200,000, which is the loan amount. In addition to that, they would have paid $164,813.42 in interest. All right, just in interest. All right, this is how the banks make their money, is by obviously charging the interest rate. All right, so in total, they would have made a total payment at the end of 30 years of $364,813.42. All right. Let me show you how an amortization schedule works. All right. So say this person got a loan in May of 2020. Their first payment is due June of 2020. So this amount here, which is the principal and interest portion for a fixed rate loan, this amount will stay the same each month and it will not go up or down. All right. Again, this is for a 30-year fixed rate mortgage, fully amortized. This is not an interest only loan. This is not an adjustable rate loan. This is for a fixed rate 30-year mortgage. So this amount will stay the same, but a portion of this amount, which is principal, will go towards reducing the overall balance of the loan, and a portion will go toward interest. As you can see, in this first payment, $750 is going toward our interest, $263.37 is going toward our principal balance. All right, so a lot more in interest than principal at the beginning of the loan. Each month, this number toward principal will tick up slightly, and our interest portion will tick down slightly. So this amount, again, will stay the same, but it will adjust more and apply more toward principal over time versus interest. All right. So as you can see, if we scroll down here, every month our interest amount is going down. Every month as we pass or as we move through the loan, progress through the loan, our principal portion is going up. So at about year, let's go to our break even point. We're going to be at about, I believe, 2035-ish. All right. So right here, January 2035, we get to the point where we're applying about a little more in principal and a little less, more in principal, I should say, than we are to our interest. So far, we would have paid in 15 years, if we started in 2020, we would have paid about $112,000 toward interest, and our balance would be reduced to $134,515. All right. So this is the point at which we break even, and from this point on, we're applying more towards the principal balance than we are interest. And as we go on, this amount again stays the same, and we accelerate through the payments here. Our balance is aggressively reduced more and more, because more of our payments going toward the principal balance and less toward interest. As we scroll down to the bottom here, at the end of the 30-year term, we have the payment still the same, but we have pretty much all of it going towards that last principal amount that's owed here to reduce it to zero, and very little going toward our interest. But you see, we've paid our principal balance down $200,000, and we've paid this much in interest, which is the same amount that we found at the top. So that's a quick example of how an amortization calendar works. If we make our equal payments and pay no more, I should say make our required payments on a fixed year term and pay no more, at the end of that 30-year term, we would have paid off the balance, but we would have paid a lot toward interest. So if you have any questions, please reach out to me. Let me know. I'll be happy to answer. We're here to help you in any way we can. Aaron, Equifirst Lending. Thank you. Have a great day.